Welcome to another episode of Millennial Investing Explained. Here's today's question. Now, I want to shift gears and talk about another strategy, and that is screen-based investing or quant investing. What this strategy is when you look at the fundamentals or financial statements or key ratios of a business and make an investment decision almost solely based on what those show you. Now, I've used this strategy in the past. This was actually the strategy that I implemented right after day trading that I mentioned before. And I implemented this because I thought that this was what value investing was. This is what I thought Warren Buffett was doing. I quickly realized that that was not what he was doing, and I decided to move away from this strategy. But essentially what a screen-based or quant-based strategy is when you invest in a company based solely on what the financials or fundamentals are showing you. Now, the downside to this is that you miss the entire qualitative perspective of the business. And I want to talk about Blockbuster for a second here. I don't know for sure that they had great fundamentals prior to their bankruptcy, but let's assume that they did as an illustrative example for why it's so important to look at qualitative perspective. So if Blockbuster had great fundamentals, if everything historically had been good because their business had been good up until it wasn't, right? So let's say that they had really good financials, everything was looking good, so you were willing to make an investment because their financials and their key ratios, and on a quantitative basis, everything looked good. But what you're missing by not considering the qualitative perspective is what's coming ahead, the challenges that are ahead. And so if you invested in Blockbuster based solely on a quantitative strategy, you would have entirely missed that Netflix was coming. If you were looking at the qualitative perspective, you might have seen Netflix coming and disrupting Blockbuster's business, and you might have been able to get out in time. And that could have saved you from losing a lot of money. So this is just one example, but it's really important to look at the qualitative perspective of a business. It's not always just the financials. Preston, can you talk to us a bit more about what a screen-based or quant strategy is?
Well, I love your point that you're talking about with quant investing is that you're looking at the previous weather, right? You're looking at all the things that have happened up until time now. But what's so important about investing is you're making capital outlays that are based on what's going to happen in the future and that expectation of what's going to happen in the future. And that's where it can get difficult with a quant-based strategy. If I was going to argue with myself, I'd tell you that the biggest hedge fund in the world and arguably one of the greatest investors of all time, Ray Dalio, uses a completely algorithmic-based decision-making model for every single investment that his hedge fund puts on. And it's the biggest hedge fund on the entire planet with, I think it's around $200 billion or something like that he manages. So that's out there too. So for somebody just to kind of take an opinion one way or the other, I don't think is a safe way to do it. I think that there's arguments to be had on both sides of it. I would tell you that a smaller size investor like myself, I use value filters to help me understand what is something I should maybe look at. And then I start implementing my approach where I value and I look at those future cash flows and all those things to try to determine a value. So if I was going to describe value investing, I personally like to use kind of an example for people. So if I was going to ask, and for people listening to this, just kind of come up with your own answer to this. If you were going to give me $100 and 1 year later, I'm going to give you some type of profit in return, what would be the number, the dollar amount that you would expect to get back from me to consider that a good investment? So you just gave me $100 and I'll give you that $100 back at any point in time. But if you gave me $100 and that represented, like, let's say I had a little tiny business and it was making money and it's going to kick off some profit, how much profit would you expect back from that $100 after one year of time? And you don't have to do any work. You just give me the $100 and then a year later. So whatever number you came up with, now you can understand what it means to invest in a stock. Let's just say that if you bought one share of a business, and this is the whole principle of value investing, is that one share of the business is the same as owning the entire business itself. Because all you do is if there's 10,000 shares outstanding, if you add up all those 10,000 shares, that's your market cap of the entire business. But let's just value one share as if we're valuing the entire business. So if you give me the $100 and I give you one share, what is that number that you're getting back? I'm kind of curious how you would respond to that. What would be the number that you would come up with if you had to answer that question, Robert?
If it was a passive investment that I didn't have to do a ton of work on, I'd be very happy with 10 to 20%.
Okay. So when we have an expectation to get a 10 or 20% return on your investment, that would be considered very high growth in the stock market today. So like companies that are doing margins of like 10 or 20%, and that doesn't necessarily mean that that's the kind of return you're going to get, but in this scenario it would be, that's a very high return. Most people wouldn't realize that the S&P 500, based on the price that you would pay for one share of the S&P 500 and the earnings that it kicks off, when I say earnings, I mean profit, it's around $3 for every $100 you would invest. You'd get that back 1 year later. It's at a 3% return based on where the S&P 500 is priced today. So when a person can put it in that context, then they can understand that, hey, I'm investing $100. I'm going to get a profit back 1 year later, and the profit is $3 out of that $100. That's what the S&P 500 represents today. That is something that anybody can understand. They can understand it very quickly. But we're coming up with a value for what we expect to get back based on our investment. So when you buy a stock, it's the exact same thing. So that profit that you're getting back, it's called EPS. That stands for earnings per share. The profit I'll get back out of this company for owning one share of the business. So if you go and buy a $50 stock and you look at the EPS on that stock and it's $5, well, your profit that little business, just think of it as a little micro business you could put on a table for $50, and there's little people in there working and they're making things and they're selling it and they're making a profit. They're going to hand you $5 back at the end of the year. That's your EPS. That's a 10% return. This is how people have to think about stock investing, because these are businesses that you're buying. This is not some hocus pocus. You buy something, you hope it goes up, you hope it goes down. So what happens with that profit after that $50 company makes $5 after 1 year? Well, the company can retain it. They can keep it in their bank account and they can reinvest that $5 to buy more assets so that maybe next year they can make $6 instead of $5. Or they can pay some of that out to the investor, the person who gave them the $50. So you could pay all of it, 100% of it as a dividend. I could receive literally a $5, addition into my account for being a shareholder of this $50 company. Or you could have a hybrid of both. Let's say I get paid $2.50. The company retains $2.50 and they use that money to grow and become stronger. Instead of making $5 next year, hopefully they're making $5.50 or whatever. This is how stock investing works. This is how value investing, a person who's a value investor is going to look at the business. They're going to look at the numbers. They're going to come up with a value that they think the business is worth. And it's completely based off of return, based on how much money they're allocating into the business to be an equity holder of that company. Whenever I'm doing investing, this is how I think. And then I augment it with, call it momentum investing or whatever else, because momentum investing is just looking at the price action. Like there's nothing more to it. Whereas value investing is looking at a whole lot more. You're looking at what assets are they going to create next year? What kind of revenue stream is that going to produce? What kind of margin is that going to produce? And ultimately, what's that going to give me on my bottom line?
I love that analogy that you just gave, Preston. I think it's so important for new investors to realize that when you buy a stock, you are truly buying ownership in a business. You're not really just buying a blip on a screen. You're really starting to own a small percentage of that business. That's all for this episode of Millennial Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.